Hello, welcome to IVoT Eye on Investing, a discussion of the markets and investing from a long-term fundamental perspective, hosted weekly by the IVoT Academy. I'm your host, Ed Butowsky. We are joined by our two esteemed IVoT experts, market analyst Andrew Tang and investment analyst Emile Westergaard. Welcome, Andrew. Welcome, Emile.
Thanks for having me.
Yeah, thanks, Ed.
Well, Andrew, we're going to start with you digesting the markets, and the GDP print is one of the things that is really, kind of surprised a lot of people. What's your take on that?
Yeah, the GDP, we were forewarned by the Atlanta Fed that it's going to be a rough one for this quarter. And we see that the actual number came in at negative 0.3%, versus the survey, very close to it, negative 0.2%. But what it is a reflection of most people or businesses. They are basically trading ahead of the tariffs, kicking into effect. And so we see that in the formula of calculating a nation's GDP, the net export, which is at the tail end of the formula, it acts as a negative component to the formula. So therefore, if we have a huge export component, then it's going to offset your positive production overall. So if you take a look at the graph on the top half, everything above that blue line at zero, you see that's positive production. So it includes inventory, and then you can also see that government, we're going through a recession because it's in the negative territory. You see that in the light blue. So the green is housing, right? And then you have the gray area, that's total consumption spending. So all that is positive. However, that is being offset. See, somewhere around 5% if you look at that. But if that's being offset, one is government spending, which is in a negative territory. And then you have a huge component, which is the net export. And again, businesses are jumping ahead. They're ordering extra amount of goods, comparable to before. This is a monstrous scale, right? A huge amount of export coming in for the January, February, and March. And therefore, you see the bottom portion of the chart shows you what are the contributions to this GDP number. And we see that it's really largely because of net export. Now, the natural question comes that will this carry over? Will this happen to Q2? And in my opinion, as tariffs are kicking in right now, the export's going to drop dramatically. And basically, global trade is going to freeze until we have a resolution. Now, the good news is that outside of China, most nations, they are already having some type of negotiation with the US. We have been given clue by Howard Lutnick and also Scott Basson that they have a lot more information than what they can tell us because of the permission of other countries. They need to wait for the country to give them permission before they can speak publicly about any of these deals. And so it is my assumption, and as well as many other analysts' assumption, that they actually have more good news they're going to announce down the road. So in terms of GDP, I don't believe we're going to fall into back-to-back like 2022, that we're going to have two continuous negative GDP. We believe that this is more of an anomaly. So, this is more of noise right now.
So one of the things that helps with the potential for recession is dropping of interest rates. You say now that the market is pricing in 4 Federal Reserve cuts for 2025.
Yeah, that's correct. And surprisingly, last week's data, because I track this on a weekly basis, last week's data, as of April 28th, the market was only pricing in 2 rate cuts. And this week, it jumped back to 4 rate cuts. So you can see the level of volatility of how the market is pricing in these kind of rate cuts. So no matter what happens, even if the market was only pricing 2 rate cuts for the year, but the total amount of rate cuts, it's still 3 to 4. So therefore, we can safely assume that the interest rate in the US, it's going to go down at least 1 full percentage point. And that is supported by the level of inflation that we're seeing. That we're seeing that there's a constant disinflation that are taking place. And as we look at, for example, the data provided by the name of Trueflation, we're at about 1.5%. And typically, that set of data, it's about 3 to 6 months ahead of the CPI data that we normally collect. So, in our view, whether we fall into negative economic data that increases the risk of recession to a higher degree, and then you're going to see companies, getting into trouble, and especially in the finance portion of it, because we have to understand there's over $1 trillion of debt that needs to roll over. And any businesses that are dependent on rolling over this debt, they're frozen right now. It's a waiting game, waiting for the Fed to reduce the cost of capital before the type of business can, continue and revive again. So it is not just the stock market that's the reflection of publicly traded companies, but there's a, a huge amount of businesses that are privately operating. And for those that are waiting for capital refinancing to take place, everything needs to thaw out because currently it is still frozen, especially in the real estate space.
So when we talk about China, which seems to be the elephant in the room, um, all these other countries are coming to negotiate, but we've left China alone.
Yeah. Yeah. So China, it's a unique situation because in our view, they're playing hardball right now. And it's really important that we understand that despite of what they give out as their formula for calculating GDP in China, in our calculation, the net amount of their GDP that are exposed to export is roughly about 40%. So 40% of their businesses is dependent on GDP, and in our view, they are suffering pretty bad. They're still going through their uh, mortgage crisis. Our version. I mean, they're going through our version of 2008, basically, and it is a reflection of a 20-year real estate bubble that is being popped right now. They're still not fully recovered from it. The insane amount of debt level, there's also disinflation or deflation that is spiraling out of control. Uh, CCP's debt is levels are spiraling out of control. The local consumption is decreasing in double digits despite of what they're showing as growth. And so, yeah, China, it's hemorrhaging right now, but they still want to save face. So last week we are, we're happy to hear that they're open for discussion, and we got that confirmation by China announcing that, oh, U.S. have reached out for negotiation versus China reaching out. So basically, they're doing that to save face. And in our view, it is a positive. This is Scott Bessen's job to handle negotiation with China, and I believe he has the personality and the demeanor to deal with China. And hopefully, we will get some good news from this, on this front within weeks, but not months. Because if the U.S. starts to see empty shelves, if the U.S. start to see price spike up a little bit, I think the U.S. Consumers are a little bit more sensitive and they're more vocal. The citizens in China, they're completely censored. They don't even dare to say anything negative about their policies and their governments. And therefore, it might lead to a lot more pain in China. We will be able to handle it a little bit better, even though, 70% of our GDP is consumption. About 17% of that is strictly, dependent on China. So we will see, but I expect good things to come out of this
I
because
saw
at 125% tariff and 145 for us on China, this is just not realistic. Anything over 25% is already not realistic. And I quote Mr. Wonderful saying that we just might as well, jump it to 400%. So you get them to negotiate tomorrow. So yeah, there are different many strategies to get the two nations to start negotiating, and that will be a positive sign for the market. We are just waiting to see how that's going to be done. And I'm actually very happy, and I have confidence in Scott Basson to get this done in the right way on time.
So I saw a chart by Torsten Slok yesterday from the Apollo Group that said that 72% of the increased costs are going to be passed along to consumers. So that's going to be very inflationary.
That absolutely is the case because when tariffs are carried out fully, they're inflationary. Yeah. And in our view, what the current administration is trying to do is to recalibrate the manufacturing sector of our GDP. And it takes time, absolutely. So, in my view, I strongly urge the Federal Reserve to start lowering rates. And I'm not saying lower it by a whole percentage point, but just restart lowering rates by 25 basis points so that even businesses that they have to build out manufacturing facilities to take on this new task will have access to capital that is a little bit cheaper, and also to restart this loan rollover, that's over $1 trillion in the waiting right now. Yeah, so that would make sense.
Well, Andrew, this has been very insightful. You always bring really great knowledge to the show. So now we're going to switch over to Emile, who is going to go through the IVoT calculator and talk a little bit more about IVoT itself. So we're going to do a fundamental analysis of Palantir today, but Emile's going to show us how the calculator works and a little bit about IVoT.
Yeah, exactly. So this week we're going to take a look at Palantir, an AI company, and we'll go through the tool from what I would call a fundamental valuation perspective, meaning how much cash are they currently generating and what is that cash worth intrinsically versus the stock price. And I think it's kind of a shocking comparison. And then we will come back and discuss what can happen in the future to get the cash flow of the company to begin to approach the current market valuation. So with that, let me just share screen and we'll start using the tools. So just to reiterate for everyone, this program is hosted by IVoT Academy. This is the IVoT Academy platform where you can access training and access the tools we use, which I'm going to show you again, the Palantir Forecaster. And here is the tool we're using this week. It's again, it's the same for every company. We do it every week. In this case, Palantir has 2.5 billion shares out. It's currently trading at $107 per share, which gives it a market cap of $270 billion. Now, in the most recent quarter, Palantir generated $41 million of operating cash flow. That was down almost 50% from a year ago, which means it has an annual operating cash flow run rate of $160 million, which according to the IVoT tool method would value the company at roughly $4 billion on the cash flow. They have $5 billion in net cash on the balance sheet. So basically it puts the company's present value based on cash flow at $9 billion, which again would be compared to the $270 billion market cap. So in other words, the intrinsic value per share right now is $4 per share. And the price to buy a share is $107. So a massive discrepancy. Now, that means very simply from an IVoT perspective, the market is expecting massive cash flow growth in the future, that we are just at the beginning of this story. And we'll talk about that fundamentally in a minute, but let's just kind of break that down a little further. So they grew sales 36% in the most recent quarter, year over year. That's pretty solid sales growth, up to $800 million. They have a very high profit margin on those sales. They're running at about an 80% gross margin. So future improvement in cash flow is not going to come really from improvement in cost of goods sold. It's going to come from sales growth, but where it also will come from is from their operating costs. Because right now they're spending 35% of sales on marketing, they're spending 20% on research and development, and they're spending 22% on G&A. That's high relative to what would be normal in a company. So if we say that they grow sales over the next 3 years and normalize their cost structure down to, let's say, 20% on sales and marketing, 10% on research and development, and 5% on G&A, well, that would in itself get the shares up to only $15. But now let's say you're a bull on sales growth and they're going to grow sales at 100%, that they're entering a big sales cycle. That starts to get you to where the shares are trading. Not quite, but close. So I could argue that the market's really expecting this if you're buying the shares. And you would have to believe, obviously, if you're looking for a bargain, you'd have to believe that sales are going to grow quicker than that, right? You'd have to believe that sales will grow 150% per year up to 12, 13 billion per year. That would get you up to $180 of intrinsic cash flow value and make you a buyer of the stock from a fundamental perspective. And again, from an IVoT perspective, we go out 3 years. This is 3 years of compounded 150% growth. We go out 3 years because we don't think you can really realistically predict any business further than 3 years out into the future. Obviously, go ahead, Ed.
And this is really emblematic of the difference between fundamental analysis and looking at a stock that's a growth company, because this is a growth company, and that's why it's selling at $114 today.
Well, right, and you have to believe in 150% growth for the next 3 years to believe you want to buy it here. That's really, it is fundamental, but a big approach to a high growth stock. And just saying, well, if you want to believe it, you can. And again, we'll discuss that now. Let's go to that. I'm just saying, in order to really not just be, oh, blah, 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 I love Palantir, I think it's going to go up. No, you want to say, what we're saying is, okay, what will it take for this thing to grow at 150% and become a $13 billion a quarter revenue company? That's what the market's basically, well, that's what you need to expect to believe it's cheap right now.
Yeah, there's a lot of speculation at play right now, and obviously from the fourth quarter, we can see Palantir has demonstrated that they can grow this business quite nicely, and as well as transitioning from a strictly data analytics company that helps drives efficiency from a consultative perspective, expanding from government contracts, which are billion-dollar contracts, very steady, but moving into the private sector. So the total addressable market, the TAM, is roughly about 120 billion, and they're growing anywhere from, let's say, 40 to 50% steadily. So by 2026, I believe that the market is believing that they can grow the revenue by $9 billion, and that's the minimum. And so with this projection and with the size of the addressable market and with what they have demonstrated, very low. I mean, when I say low cost, it means that they're not dependent on making widgets, right? So they can expand it with scale, and therefore their spend on research and development over time will also are expected to come down as well as you know, as all innovation as we go through it, and therefore when you put all the pieces together, that's how you get a high growth company and a high multiple that the market is willing to pay for it. You know, same with any other tech companies, software companies, you know, like Microsoft, Apple, it is the same deal. And therefore, it is very difficult to understand that if we're just looking at what they are reporting. You know, we need to look at the forecasting and obviously very high assumption numbers.
Yeah, I mean, the limits, obviously, of the format here, we can't go deeply into what really needs to happen to grow sales at, you know, well, if it's 40%, you know, that's not going to get you to over $100. It's going to get you probably to 60 to 70.
Right.
But which is still a great business. It's just I don't know if you want to buy it at $107 a share. I don't know that you're getting a bargain right now. You might want to wait and see. But that again, we're not making investment recommendations. What I'm trying to get people to do is want to use our tools and do their own forecasting and study the company and study their marketplace. So, you happen to know, I think AI is a marketplace better than me. I don't know what their real competitive advantage is in what is obviously a increasingly, competitive space for AI tech.
Yeah.
So in closing today, I want to thank all of you for watching IVoT Ion Investing. IVoT's sophisticated yet simple tools equip you to analyze, forecast, and manage your financial future, including budgeting, investments, credit management, wealth planning, and business management. Click on the link in the discussion to go to our IVoT Academy website at IVoT Academy to learn more about our tools and training and register for a free trial. So I encourage everybody who's watching this to take some time and go to IVoT Academy and learn. It's very inexpensive to do on a monthly basis. You'll learn a tremendous amount and hopefully will take a lot of the financial stress away from your life. So thank you very much, guys.
Yep.
Thank
Thanks
you.
for having me.